Today, we're going to talk about how one might go about analyzing SaaS stocks. And the goal of this presentation is for anyone, whether they're a beginner investor or an advanced investor, anyone can go and look at a SaaS company and use common metrics to gauge how healthy the company is. Now, some of you may be wondering what SaaS is, so let's start there. The acronym stands for Software as a Service, and this is simply delivering software applications over the internet from a server that is hosted by typically a cloud provider like Amazon or Google somewhere far away, and clients pay you money to access that, and typically that will be in the form of contracts. So this is changing. We'll talk a little bit about the structure of SaaS contracts. And the end result, when you look at a SaaS company, it should look something like this. And I'm not sure which firm this is, it doesn't matter, but you can see this beautiful annual chart here on the left, growing revenue stream, and on the right, you can see that growing quarterly, and there's consistency there. That's something that investors look very favorably upon. And you'll notice here that this firm is losing money, but we don't focus much on that, and we'll talk about why that is. Now, when we look at SaaS firms, we typically ascribe higher valuations, the market does, to SaaS companies. And there are a number of studies and institutions that look at this. But the reason for that is basically from the chart that you saw before, SaaS firms generate predictable revenue streams that are usually heavily diversified. They use easy to understand metrics for business health that we'll cover today. And they also either lock their customers in with contracts or provide a solution that's so durable that it's not easily replaced. There are about 112 known SaaS stocks from the research that we've done. In our own tech stock catalog, that's an Excel spreadsheet that we provide to subscribers with about 430 tech stocks in there. 27 are pure SaaS, and they're flagged as pure SaaS, and then have let's say 49 have some elements of SaaS. And I think we've defined that to say you have to have 90% or more of your revenues coming from the SaaS offering in order to be a pure SaaS firm. And there are other companies out there, let's say, may have 10% of their revenues coming from SaaS, and they're looking to grow that because they know the market ascribes a premium, as we said. And this firm, SaaS Capital, they're in the business of loaning money to SaaS firms. That's a good business to be in because they know that these firms are quality companies, and that's the business they've chosen. And they've also done a lot of looking at metrics. You can see on the chart on the left here, the sharp drop in valuation for SaaS firms that accompanies the drop of the broader market. In other words, this is a great time to be adding quality SaaS firms to your portfolio. And on the right-hand side here, they've done this simple chart that shows the performance of SaaS compared to the NASDAQ composite and the S&P. Again, you can torture the data and make it say anything that you want, but typically SaaS firms outperform the broader market because they're quality businesses. Now, to understand a SaaS firm, we need to start with the basics, and that is run rate. So we're going to use the example of lemonade stand software. So let's say that we've built a piece of software that anybody who operates a lemonade stand can use to more efficiently run their business. And we're charging $100 a month for that. And the advanced version is at $200 a month. So let's say that after the first year of operations, we have 10 lemonade stands paying us $1,200 a year. Well, we can do the simple math, 10 times $1,200. That's a run rate of $12,000 a year. Now, this is quite important to understand. If nothing else happens, if that was always the same every year, we'd receive $12,000. That's our run rate. Now, of course, things change. And here are some things that could happen. So, for example, we could raise our prices by 5% to keep up with inflation. If that was the case, then our run rate would go up by 5% to $12,600. We could also get a new customer, in which case we've recalculated that 11 times 1,200, our run rate goes to $13,200. We could also lose a customer, run rate drops. Or we could have an existing customer upgrade to the advanced package, in which case we have 9 customers paying us $1,200 a year and 1 customer paying us $2,400 a year. The total is $13,200. That's the simple concept of run rate. And here you can see run rate for UiPath. Look at that beautiful growth. And it's important to note that run rate doesn't equate to revenues, and this can be quite confusing for some. And the reason for that typically involves timing and invoicing and accounting bits, things that are too, let's say, complicated and uninteresting to discuss here. But one example might be this. Let's say that you signed a 3-year contract with a customer and you charged them 50% of the contract in year 1 and 25% in the following 2 years. Well, that would be an uneven revenue stream, and revenues would appear differently from your annual revenue stream, or say annual run rate, which would be simply the total value of the contract divided by 3, because that's what you would expect to bring in. So it can get confusing if you start trying to reconcile that with revenues. But going back to that earlier example, it's quite simple. This is the money you expect to receive from customers that are contractually obligated to pay you this money. So let's look at something a little bit more advanced, what they call net retention rate. So this involves all your active subscriptions. So forget about any new customers. So let's say we calculated net retention rate for our lemonade stand. Well, remember, we had 10 customers paying us $1,200. That's $12,000. If nothing changed at all, the next year we would receive 100% of that money. But things do change. What could happen? We could raise prices by 5%. In that case, we're getting 105% of the money that we did last year this year. So our net retention rate has gone up. It's 105%. If we lost a customer, it would fall to 90%. We're only getting 90% of the revenue. Remember, we could get a new customer. That doesn't affect net retention rate. Where net retention rate tells us how much money existing customers are paying us based on the last time frame that you're comparing it to. So what we could have happen is a customer could upgrade to advanced. That's great. That means our net retention rate goes to 110%. The existing customers that we had before are now paying us 110% of the money that they did in the previous time frame. So typically, as you would expect, net retention rate is always above 100%. It actually averages about 114% for public SaaS firms. And when you look at the size of the contracts, typically you'll see a higher spend from customers that are paying you more money. That's fairly intuitive, right? And that usually has to do with commitment and getting larger signatures, and the fact that when you have larger commitments from a firm, they're usually looking to do larger deployments. So the next concept we want to look at is gross retention rate. Most firms don't provide this. They only provide net retention rate. We like to see gross. Gross shows us revenue lost from your customer base. So percentage of revenue retained from customers without taking into account downgrades, or I say not taking expansion into account. So what you are taking into account is downgrades and cancels. So if nobody canceled and nobody downgraded, you'd have 100% gross retention rate. Rarely do you see that. Median for SaaS companies is typically around 90%. For SaaS companies selling to small or medium businesses, a good gross retention rate is 80%. Going back to that point about how the larger the contract, the more likely a company is to pay you more money. And here's a great example from SaaS Capital that demonstrates that. It shows how you have both higher net and gross revenue retention. This ACV stands for annual contract value, and that's simply the average contract value of your client base. So if a client's paying you more than $250K a year, they're less likely to cancel, more likely to pay you more money than if they were only paying you $6K a year. Again, that's quite intuitive. And here you can see these ACV buckets for, I think this is Twilio, and they show you 2017 compared to 2020 and the number of customers in each bucket. So if we go to the right-hand side, this is pretty important. The number of customers paying them more than $10 million jumped from 2 to 7. So you want to see increases across all those buckets as you migrate your customers into greater and greater spend on your solution. And customers will spend more on your solution when it's durable. That means that they can't run their business without it. So an example we've given here is robotic process automation, which saves firms money like UiPath, versus a consumer marketing testing SaaS offering that may, when it comes time to tighten the purse strings, that may see a budget cut for the marketing team. So for durability, it's not just about locking your customer into a long-term contract, because you can also have usage-based pricing. It's how indispensable is the solution that you're selling. So other considerations when we look at SaaS firms: customer concentration risk. We want to make sure that no single customer accounts for more than 10% of revenues in any business, of course. Industry agnostic. So there's healthcare SaaS firms out there, which we don't look that highly upon compared to a firm like UiPath that sells across multiple industries. Here's a chart showing the breakdown of their ARR, annual run rate, across these different industries. And when we look at the potential for a company, there's this concept of total addressable market, all the money that they could potentially capture with their solution. Blue ocean means there's nobody capturing it. That's a great place to be. If you're capturing, you're not having to steal market share from somebody else. And there's this notion of SAM versus TAM versus SOM. Wanted to touch on this quickly because firms will mention this. And more or less, it comes down to the serviceable, obtainable market is the percentage of the TAM that you can realistically capture based on your offering. And a good example here would be languages. So some countries, you need to have your software application localized. And if you haven't done that, then you may not be able to enter the Japanese market. So realistically, you can't capture that until you spend money localizing your solution, which means making it available in other languages. Here you can see how UiPath has broken down their offering into these different buckets. And you can see their current portfolio, $61 billion. They hope to expand that in the future to $93 billion. So that's really the opportunity that's in front of a firm. And when it comes to survivability, remember we talked about how we don't pay much attention to losses, because the more customers that you get on a platform, typically, the more your margin expands. You're providing the same solution, but you're getting more money from providing that same solution. So you can see here that a lot of SaaS firms have very strong gross margins, which means that if they start running tight on cash, what they can do is start cutting their variable costs down and taking advantage of their juicy gross margins. So just to conclude, SaaS business models are highly desirable. We've looked at why that is and some metrics that you can use to assess SaaS firms, regardless of what sort of offering they provide. Durable SaaS solutions do better in bear markets. That's why you should understand how durable a solution is. How easily can it be displaced by competitors? If it's a blue ocean, then it's certainly a lot stronger position than if there's somebody else offering something similar. And pure SaaS firms will always provide relevant metrics. They should provide these relevant metrics so you can gauge the health of their business at any given time. So please put your comments in the comment section. Make sure to subscribe to our channel. Thanks for taking the time to watch this today.